Hey, this is Brian Kurtz with the Short Sale Show, the show where we talk about how you can avoid foreclosure, save your credit, and bring little to no money to closing. Today we're going to wrap up our three-part series on deficiency balances. How exactly do mortgage companies and mortgage insurance companies handle the losses that they incur through the short sale process, the short refi process, or worst case scenario, the foreclosure process. Now, in the first episode, 2 episodes ago, we talked about the three basic scenarios that they pursue in a short sale. First of all is the write-off, which is usually the best for everybody because the bank just writes it off and gives you a 1099, which may or may not, probably doesn't, have tax implications on you. We went over that. Scenario number two is that they pursue you for the entire amount. They require you to reassume the entire deficiency balance in the form of a soft promissory note. Very rare. We talked about the reasons why it's very rare. Feel free to check out the episode on that if you weren't clued in on that part. And of course, number three is the hybrid, where they require you to reassume a small portion of it, but then they write the rest off. That's a pretty common option as well. It's kind of like they're not giving you a full get-out-of-jail-free card, but they require you to reassume a little bit, but take the larger portion of the loss. Now, we're going to talk a little bit about deficiency balances, get a little bit more in depth. We talked about how the mortgage insurance company as well as the mortgage company itself can pursue for deficiency balances in various ways in the last episode. And we're going to wrap it up and talk a little bit more about that in this episode right here. So let's go over a real quick scenario. And what I call this is the lifeboat fallout. So we haven't talked about this, but a lifeboat scenario is this. You know that you can't afford the house, but you see all these foreclosures in your neighborhood and you're like, man, that house across the street is awesome. In fact, it's just like my house, but it's $300,000 less. I mean, I just can't even believe it. So you as the husband in the family have the mortgage in your name, but your wife also works, has a pretty good job too, but the mortgage is not in her name, so it's not affecting her credit that you currently are behind on payments. So the lifeboat scenario is where the wife gets a new mortgage in her name and buys the house across the street, pretty much the exact same house, maybe not across the street, but down the road or whatever. And you move the family into the new home, which you can qualify for because it's cheaper, and you stop making payments on the old home. So it's kind of like you jump from the current house into your lifeboat, in which case you then try to arrange for a short sale, or you just let the old house go completely into foreclosure and don't even worry about it anymore. One person takes the credit hit, but hey, you jumped out of the one and you're in the lifeboat and you keep on paddling, right? So that's the lifeboat scenario. Well, I do know of one story, not mine. I wasn't the one negotiating the short sale on this one, but somebody else in my company was. And the people that they were working with on a short sale were in this exact same scenario. And what they did was, this was right before the stated income loans pretty much got cut off. The family did with this exact scenario. They went to the house right across the street, moved into it, bought it on a stated income loan in the wife's name, and the other house was going down. And the fact of the matter was, the mortgage insurance company the mortgage company looked at this entire scenario and looked the whole thing over when they submitted a short sale application and said, no, oh no, we are not going to work with you on this. In fact, we're not going to work with you at all. Based on what we see here, you qualified for a new house. Somehow you're able to qualify for house A and house B all at the same time. That means you have money somewhere, and you should have been making good on your obligations here. So let me tell you something. Usually we don't pursue for deficiency balances, and we don't go after people for negative amounts after foreclosures. But not only were we not going to give you a short sale, not only were we not going to allow you to have a short sale, but because of your malicious intent to defraud us in this particular scenario, we are not only going to pursue a foreclosure, but once the foreclosure is done, we will go ahead and go after you for the deficiency amount. Any amount of loss that we take, we're going after you for it. So they were kind of vindictive. This is very rare because usually the bank's thinking, hey, let's just do whatever we need to do to get this sold and mitigate our loss. We're going to lose more if we go through foreclosure than doing a short sale. In this case, they got personal for whatever reason, and they said, we don't care about the money, we're coming after you. So the fact of the matter is, after a foreclosure, unless you live in a state which is called a non-recourse state, there are a few non-recourse states where if you bought a house and it's a purchase money mortgage and you go into foreclosure, they cannot pursue you for the balance. I'm not going to give you a list of which states are recourse and which states are non-recourse. Majority of them are recourse states, so any loss that the lender takes, they can pursue you for it. But in any case, it's not usually very common. Reason being is they have to pay an attorney, which is even more cost being dumped into this bad loan, basically tied to one loan. And they might get a deficiency judgment against you. They might not get a deficiency judgment against you, but they still have to pay the attorney. In any case, if you're really in a hardship situation, they could get the deficiency judgment against you, and then you can't pay anyway, which is the reason why very often they're not going to pursue you for it. However, the fact of the matter is they can. And not only can they, the mortgage company, but the mortgage insurance company, since they are the ones also assuming any type of loss in this scenario, because remember, mortgage insurance policy protects your lender, doesn't protect you. You're making the payments, but you're protecting somebody else. Really what you're doing is you're saying, hey, I'm going to make the payments on this loan no matter what. I guarantee to make the payments. And because I owe more than 80% of the loan to value on this particular home, I got to get a mortgage insurance company, and the mortgage insurance company is the one saying, hey, we're going to guarantee that this guy's word is true. He promised to pay and not go into foreclosure. If it goes into foreclosure, we will go ahead and kick you, Mr. Lender, back the money for any loss that you assume. So if you break that promise and you do go into foreclosure and the mortgage insurance company realizes any loss, then because if you're in breach of your insurance policy, they can pursue you for a deficiency judgment. Once again, that does depend on if you're in a recourse state versus a non-recourse state. So take it all with a grain of salt. But in any case, if you are facing a short sale, a short refinance, or a foreclosure or a deed in lieu, this does come into play. You may want to make sure that your mortgage insurance company is not requiring you to saying that they're going to pursue you. You might want to get it in writing if you can. Sometimes you can't. Most of the time, they're not going to pursue you for any negative amount. But just so you know, there's no way to guarantee unless they do put it in writing, and most mortgage insurance companies won't. The mortgage company itself will put it in writing that, hey, we're the short sale is approved, and after this is all said and done, we're not going to pursue you for anything like that. You can usually get that in writing. But if you have mortgage insurance, and it's very difficult for them to sign off on that in writing. Let me make one last point before we wrap up. If you are with Radian, a Radian mortgage insurance policy is on your home, you have almost a 100% guarantee. If you do a short sale, they're going to want you to reassume some portion of it, usually anywhere from 10 to 25%. Usually they're going to restructure whatever that reassumed amount is at 0% interest amortized over however many years. And I think it's usually a pretty good deal. Think about it. Let's say negative amount's $100,000 and they require you to reassume $20,000 of it. What you've just done is you have bought $100,000 with 20. How many times in your life would you like to buy $100,000 with $20,000? Probably like as many every day of the week, right? So you bought $100,000 with $20,000. Not only that, but you bought it at 0% interest if they restructure it at 0% interest. And also you're using money, you're financing this purchase with money that you've already borrowed. So it's usually a pretty good deal, and which is why all of the sellers that I've come through that have been given choice A or B, hey, we'll approve the short sale, but you got to reassume some, or B, we're not going to approve the short sale, you can go to foreclosure. They usually go ahead and choose to go with the reassume a portion of it in the soft promissory note because it feels beneficial to them. All right, so that pretty much wraps up our three-part series on deficiency balances. We may end up touching on this in the future as things change and develop. Once again, if you are watching this from my own website at shortsaleshow.com, make sure to go ahead and leave a comment if you have anything to say to ping off of this. And also, if you want to share this with the world, click some of those buttons like the dig, the technorati, the stumble upon buttons, the delicious buttons, so that people can know that this is a resource for people looking for answers about short sales. If you felt it helped you, it might help somebody else. Thanks a lot. Once again, I'm Brian Kurtz, and you're watching The Short Sales Show.